Get ready for more valuable financial insights from Northern California's premier retirement income planners, Dan Ahmad and Jim Files, owners of Peak Financial Freedom Group. For more information, go to peakfin.com. And now, here's Dan and Jim.
I'd like to welcome you to the Peak Financial Freedom Hour. I'm Dan Ahmad, here with my partner, Jim Files, and we'd like to thank everyone for listening. Some of you might have been listening for years, decades. Some of you might have been listening to this show for the first time today. Either way, you're going to get a lot of information. You're going to find out that Peak Financial is different as far as being a planning firm, a retirement income planning firm, than probably any other firm you've listened to or talked to before. And we'd like to throw a shout out to those people who have been listening to us for a while. We know a lot of people, they'll listen for 2, 3, 4 years and then finally say, yeah, you know what? I do need some help, and they'll come in. Well, if you think you need help, don't wait 3 years or 5 years. Call now. Dial pound 250 on the cell phone and say the keyword money, pound 250 and say the keyword money, and you can talk to our representatives and learn about getting a free financial consultation and even a free retirement income plan. At the same time, if you like to read and get information, call us at pound 250, say the keyword money, and we can get you a copy of our most recent book called The Golden Promise, which outlines exactly what you need to do to create an actual written retirement plan so you have what's going to happen over the next 30 years of your life in writing. Well, Jim, today we're going to talk again about an area that I think is very important for people to understand, and this is the emotional side of retirement planning. So we're going to talk about statements that you may live to regret. And these are statements you've either made in the past or maybe you're making right now. And what we're talking about is things that might not come true that you're banking on. Kind of like that one religious joke that I love it. And it's basically man or women makes plans and God laughs. Because whatever you plan, you better be planning the opposite. And we talked about this on the last one. We looked at an example of the engineer who engineered the Titanic. And he said, even God himself could not sink the ship. Well, we know what happened. And he regretted making that statement at some point in the future. So today we're going to talk about the financial statements people make that in many cases they might live to regret. But if you can, start us off with the financial wisdom tip of the week.
Well, this comes from Alan Greenspan. He was a previous Fed chairman. He says the number one problem in today's generation and economy is a lack of financial literacy. He's not saying people are stupid. He said people lack the literacy in today's economy to make sure that their assets are positioned correctly. And in our example, to make sure they're positioned correctly so that your income will never run out. I mean, that's what he's really saying, because he's looking at the population base. There's 10,000 people retiring every single day now. And the vast majority of those people don't have enough money to retire. And the few people that do have enough money to retire, they don't know how to position those assets to make sure they don't make a financial mistake and to make sure they're going to have enough income for the rest of their life, Dan.
Well, the scariest, craziest, I just think I can't even fathom, though, there's 10,000 people retiring. Probably 10,000 do not have an actual plan. And people will argue, they'll say, oh, no, I have a 401k plan, I have an IRA plan, I have a brokerage plan. Those are your accounts, those are your statements. But if 10,000 people retire today, do you think many, if any, are going to actually have every single thing about their money in writing that would constitute things like how much risk they're taking right now, and then how much risk they really want to take, how much income they're going to receive throughout retirement and where the income is going to come from, how much tax they're going to pay, how much their net income is going to be compared to what their budget is, the fees they're going to pay, all those things in writing. And out of 10,000 people, if it was lucky, maybe 10 people had a plan like that. I'm going to say basically maybe one person has a plan like that.
Maybe one. People ask all the time, why didn't I know about the level of risk I've had in my portfolio all these years? Because we mentioned in our last show that every 5 years since 1929, the Great Depression, the stock market crashes an average of 39%. In other words, you lose about 39% if you have your money in the stock market, right? Well, that's historical. That number is, you look at up any place you want, you'll see all the different crashes that occurred since 1929. You say to yourself, well, why didn't my broker actually tell me this before it happened? Well, if he told you this, you wouldn't have invested with him, period.
Well, think about it, Jim. I just thought of a cool thing because I was in Vegas to see a show for the weekend. I didn't gamble once. I did not even put $1 into the thing. I hate losses. I don't know if any of you are listening right now. If you hate losses, then you'll get along with Jim and I well, because we don't like to waste or lose our money. But I just thought of something, and it was pretty cool. I thought, if you think about how the stock market advertises and what brokers tell you, they're always selling you on big gains.
Yep.
They don't sell you on, oh yeah, my client, my client made $1 million on the stock. They don't say, well, my other client lost $1 million on the stock.
Yep.
How do casinos sell you? They
Same
sell
thing.
you on the big gains. They go, $535,000 jackpot winner, $222,000 jackpot winner. They don't say this guy lost his butt and lost 500,000 and lost his house and got divorced and no longer is in communication with his family. It's the same thing. You have to focus on the worst case scenario.
Yeah, but people don't understand this. I don't know why. People are bright, but they don't understand this.
Well, you know why? Because they've never been, you said it earlier, they're illiterate, not on their fault, but because they only know what they've been told by someone else about money. That's their entire knowledge base, isn't it? What they've learned, and what are all these other people telling them about their money?
Keep it in the market. You're going to be fine. You can take out a lot of money. You'll never run out of money. You're going to have some ups and downs, but we'll show you there's going to be more days up than down. And we'll show you that if you are out of the market at the wrong time, you won't succeed. So you have to stay in the market no matter what happens, right? That's what they tell you.
How about this one then? I think you and I saw this. It was a client that we both reviewed, and they had about $2 million of assets right now. Their big, huge 401k company, which everyone knows, told them they could take out about $140,000 a year, okay, which is 7% payout.
Yeah.
And 30 years down the road, their $2 million would grow to $4 million.
Yep.
And when you look at that, it's like, okay, do you really think that's going to happen? And maybe 1 in 100 chances, yes, the stock market just goes straight up. It would happen. 99 out of 100 times, there's a high probability that's not going to happen, and you're going to run out of money. And then in another case, and I want you to comment on both of these, I had a client where he had about $3 million and they said, okay, you can take out 80,000. I'm like, okay, that's more realistic for where he has. Yeah. And he's single. When you die, there'll be $12 million. He goes, I asked the advisor, he goes, why the hell would I want $12 million when I'm dead? And the advisor said, because that's a really good amount to have down the road. That was the answer.
Yeah. Well, the broker said that because if I only took out 2.5% of my $3 million and I invested the rest of it, who makes most of the money? The broker does. The broker gets the advisor fee, right? He doesn't want you pulling money out of the market. He wants that money staying in the market so that advisory fee gets higher and higher and higher. But, Dan, we do this every day, and people listen to our radio show, and some people call in. Some people say, I'll call in the future. Some people don't call in at all. Some people say, I'll have an advisor. I'm just fine. It'll work out. But people become so complacent in life, and I don't really understand it, because they get to a point in their life where they finally made it. They're going to retire, or they're in retirement. They know they can't make a financial mistake. They know that in the back of their mind, but they get kind of, I don't know if it's greedy or they get caught up in the hype, and they just think this market will never go down again like it's done in the past. But history does repeat itself.
But it's not the client's fault. It's the advisors, the advice they're getting from either their current advisor, their 401k, the internet, or their best friends. They're getting advice that fit when they were 20, 30, or 40. So there was nothing wrong with it. In fact, it was 100% the way they should have been doing it. It just no longer fits if you're retired or within 5 years of retirement. You better not be investing the same way you invested when you're 40, because you have too high of a probability it's not going to work. And when you think about it, it comes down to, making the decisions. Here's one of the subjects today, as far as things you might live to regret. We should defer income as long as possible. We can start using it later. And if it's an IRA, we'll just take out whatever we need to take in minimum distributions. And because of this, we'll save taxes. Well, that is the exact opposite that we're going to recommend in almost every case, because if you're 60 and you defer taking your IRA distributions till 73, which is when you have to, and let's say you have $2 million now, you don't take any money out, just at a low rate of return, the $2 million might be $4 million, and you haven't used it for income during the time period. And now you're 73. Now you have to take minimum distributions off $4 million. Why in the heck would you want to grow your assets that they're going to force you to take it out when we're older? You can spend it a lot better between 60 and 72 than you can between 73 and 85. And if you create what we call a levelized income distribution plan, you're going to overall pay less taxes, and there'll be less taxes passed on to your beneficiaries if we create the plan that way.
Yeah. We were talking about right before you made that comment, we talked about a few minutes ago about just people not understanding the risk. But I bet you right now, if we had 100 people walk in here, they all had more than $1 million in investable assets. They're all around the age 60 to 70. And we asked them right now, do you think the stock market's overvalued? I would say every one of them would say yes. You think the market, because it is overvalued, you think it might drop in the future? And I would say every single one of them would say yes. Because of the way you're positioned right now, do you think you can lose much money? And they all say, well, yeah, maybe we probably could. They all know this, Dan, but they sit there and every day they wake up and they look at their iPhone and they hope that the market's is green. They hope that they see all green and not very much red, and they hope it's going to work out. But hope and luck, folks, doesn't get you through retirement, because there will be a market reset. You will be positioned incorrectly. And once you make the mistake, you can't undo the mistake. It's already made. There's nothing
No,
you can do about it.
across the board, just like what we're talking about with this subject, basically deferring money for no reason, just because you thought it would save you taxes. Very, very rarely have I found, when I've done the calculations in deferring your retirement distributions, IRAs, 401ks, etc., until you're 73, will result in less taxes. It'll result in a lot more taxes because of changes that were made to the tax code several years ago. The big one was, oh yeah, we'll just defer it to 73 and then just start taking our minimum distributions, and when we're gone, it'll pass on to beneficiaries and they can take it out over their lifetime, spreading the taxes over 30 or 40 years, which was awesome. It was the best way. The problem is now, whatever amount of money you have in your deferred accounts, your beneficiaries have to take them out over a 10-year or shorter time period and pay all the taxes on that. How is that ever going to decrease taxes overall in the amount of money you're going to pay on your IRA? And it's not going to. You're back with Dan Ahmed, Jim Files, the Peak Financial Freedom Hour, and we are talking about statements you'll live to regret. So let's just look at things that you might have said in the past that might not be the best things to do going forward. Here's a big one. We've never had a budget and we don't need a budget. Well, most of our clients, all the way between the time they started working and the time they retired, they didn't really follow a strict budget, but they knew how much money they made, meaning how much they brought home every month, and they knew they never were going to spend more than that, and they knew they were never going to jack up their credit cards, so everything was fine because they had a certain amount of income, they spent less, and they saved the excess. That's awesome. The problem is the good thing was they were getting paid paychecks then, so they could they knew 100% that if they went to work, they'll get the paychecks, they had enough money, and nothing bad would happen. At retirement, though, if they don't have a pension, which 90% of you don't, or don't have big pensions, we need to know, first and foremost, the most important part of their entire plan. The most important thing isn't the amount of assets you have. It's what is your retirement budget, meaning how much money do you need to spend and have come in on a monthly basis to make sure you cover every single cost. And you don't want to be tight with this budget. You want to have it being a little fluffy budget, because we never want to not have enough money each month. So let's say your budget's $10,000. A lot of people would say, okay, let's create a plan that gives you $10,000 a month of net income. Great, you hit your budget, but that will make you worry for the next 30 years. If your budget's $10,000 a month, you better make sure you create a plan that gives you $13,000, $14,000, $15,000 or more of net income after taxes. Because if you have $3,000, $4,000, or $5,000 more to spend than you need, you won't worry about your money as much. And every single plan we create, we try to hit those minimum numbers. In a lot of cases, have a lot more. I just did a case for a client, couple. They have 2 Social Securities. They have rental income of like $2,000 a month. They have $2.5 million of assets, and they had no idea how much net income we could create. We created a plan that's going to give them about $22,500 of net income per month after taxes. Are they going to be able to live knowing that their income when they worked was $12,000 a month after taxes?
It's crazy, right? And people don't know they can do this. And the beauty about it, Dan, if we were to ask every single investor that comes in here, would you like to have a guaranteed paycheck for the rest of your life? Every single one would say yes. Why, they'd be stupid not to say yes, right?
Well,
And
especially if they can get a guaranteed paycheck that would be based on 7%, 8%, 9%, or 10% of their original investment that's now going to give them those type of payout rates guaranteed for as long as they live, then they say, heck yes, because they don't even think they can get that.
Yeah, and what that means, if you translate that into dollars, if you're getting an 8, a 9, or 10% distribution rate, say you defer not starting income for 2 or 3 or 4 years, and you're getting 9% distribution on say it's $1 million, that's $90,000 a year of guaranteed income that will never run out, that we can put in your plan, whether you live 20 years, 25 years, 30 years, you live to over 100, whether you have money or not. That $90,000 a year in my example is going to be there forever.
Well, think about it. What do people want? And no one else is talking this language. We know what retirees want because we've been meeting with them for over 40 years. We met with over 4,000 people. Number one, once they retire, they don't want much, if any risk. Some of them want no risk. And they think because of what their current advisors or what their 401k company says, they have to continue to take risks to be successful. But if they're retired or getting ready to retire, they all want minimal, and most of them prefer no risk if they can do a plan like that. Then they want the maximum income they can get off their assets as long as it's not going to run out for as long as they live. And they want the maximum income as long as they're not going to be in a high tax bracket. And they want the same, if not preferably a lot more net income when they retire than when they're living. And it's not unusual that if someone was making $8,000 in net income between them after all their deductions, that we jump it up to 12, 13, or 14,000. It's not unusual. They made 10,000. We jump it up to 16 or $17,000 a month of net income after taxes. That's not going to run out for as long as they live.
And that's a goal, folks. It's retirement time. If you're listening to our station, right? We're talking to people that are getting close to retirement or in retirement. That's why you tune into us every week, is because we're trying to show you how this can work, how you can lower the risk. I call it de-risking your portfolio. How can you eliminate the massive amount of money that you could potentially lose and convert that into a plan that you have a lot less risk. In some cases, no market risk if you don't want it, but more importantly, that you have enough income that will be generated off those assets that it took you 40 years to save. You don't want to make a mistake right now. You have to figure out, how do I reposition those assets to make sure that income will never run out?
Well, what you're talking about really is maximum risk gives you the potential and opportunity for maximum gain, but it locks in the lowest amount of income that you can take off those assets. So at retirement, do you really want the maximum gain with the minimum income, or do you want the minimal or no risk with the maximum income? Because the less risk we can take, the more income we can take out of a plan. So we don't want you to go away from thinking you want the maximum of something. We just want you to focus on the right maximum. So instead of maximum growth, we want the maximum income that's going to be guaranteed to be paid you for as long as you live with the least amount of risk. And if you do that, you'll be in such a better position. If you'd like to get a copy of our most recent book called The Golden Promise, simply dial pound 250 on your cell phone and say the keyword money. You can talk to one of our representatives and we can get you a copy of that book. It's a great book, easy to read in 2 hours, and you understand what you need to do to create a written plan. If you'd like to meet for a free consultation, again, just dial pound 250 on your cell phone, say the keyword money, and we can talk about how we can give you a free second opinion, as well as give you a absolutely free of no obligation written retirement income plan. And I think that'll help a lot of people.
Yeah, in the book you talked about, Dan, it's a great blueprint. It's an easy read. If you pick it up, you can read it probably in one evening. It tells you what you need to know about retirement. It tells you how you need to take your thought process and put it in the plan so that you don't make a financial mistake and that you'll have enough income for the rest of your life. So,
well, and there's a 1 minute, 14 question test you can take in it. And if you answer those questions, it'll tell you specifically, do you need help or not?
Yeah, and it's free. All you have to do is call our office. We will give you a free copy. There's no obligation to even meet with us, but it will help you answer those retirement questions that you have in the back of your mind. This book, again, is easy to read. It's very digestible. And even if you don't come and meet us ever, you'll be that much ahead of where you were before you called us.
You're back with Dan Ahmed, Jim Files, the Peak Financial Freedom Hour. And today we are talking about statements that you might live to regret. These are things that you might have said or thought that might cause financial pain in the future. We talked about how some people think we should defer income as long as possible and not take any money out until age 73 when we're required to take our required minimum distributions or RMDs. Second was, we don't need a budget. How about this one now? This is for people where one of the spouses is handling the investments and really likes doing it. And the spouse says something like, oh, don't worry, honey. I know there's a lot of volatility in the market, but we'll just hang in there and write it out because that's what we did to get here. And that's how we accumulated $1 million, $2 million, $3 million, $5 million of assets. We hung in there, we wrote it out, we're in it for the long run. And that's exactly what they should have been doing if they were 20, 30, 40, even 50. The issue now is these people are 60, 65. They're retired or getting ready to retire in the next 5 years. And you cannot use that philosophy of hanging in there, write it out, everything will work out, you're in it for the long term, because you're not. Time is no longer on your side. At this point, we have to now, as we talked about earlier in the show, we have to transition immediately from the maximum risk with the maximum growth potential and minimum income to minimizing the risk or eliminating the risk so that we can get the maximum income and have the highest probability our money won't run out, or even better, have a written contractual guarantee that our income won't run out.
Yeah, you made that comment a minute ago. hang in there, write it out, stay the course no matter what happens to the other spouse. Well, we see so many people that come here daily that one of the spouse doesn't have any idea what the other spouse is really invested in. They're just assuming it's going to work out. Or worse than that, both spouses have relied on just a portfolio they put together years ago. They did stay the course. They have no idea what level of risk they have in that portfolio. They have no idea how much they could lose. They're excited because the market's gone up significantly in the last few years.
Exactly. They made that's a big point there. Like, I've done such a good job because the market's gone up, so they just went along with it.
That's right.
But what's going to happen when the market goes down?
It's going to go, and people think when it goes down, I'll get out. I'll be able to get out quickly. It doesn't work that way, folks. You don't get out quickly. You write it down. You say to yourself, okay, it can't go any further. It starts to come back up. You have that false hope. Okay, it's going back up, and then it goes down again, right? You got that false hope. It goes up. Oh, then it goes down again. And pretty soon you wake up years later, and you could be down 20, 30, 40, or 50%. And then all of a sudden, those jubilant years where you made all that money, it's vanished, folks. Now you're older, and you have to be able to take those assets and say, how do I make these work for the rest of my life?
Well, and we're not saying what a lot of people think we're saying, that you never should take risk, etc. You should have done that and took as much risk as your stomachs would allow you to take from 20, 30, 40, even at 50, because then it gave you a statistical probability of getting a significantly higher rate of return during that time period. Well, to get a significantly higher rate of return during the time period, you have to take a lot more risk. And at retirement, everyone listening right now knows they can't take a lot of risk. So let's do a couple tests. One is, if right now, let's say you have $2 million of assets or whatever amount of assets you have. Right now, let's say you stay aggressive and you think the market could go up another 50%. Well, your $2 million would grow to $3 million. And the first question I ask is, if that happened, would that really change your lifestyle if you left the money in the market? Would you feel better about spending a lot more of it? No, because you'd probably be freaked out that now it's even a bigger value and you still have money at risk. What happens, though, if the market goes down 50% and your $2 million goes down to $1 million? Will that change your lifestyle? And the answer is 100% it will change your lifestyle, and you will never use it until it recovers. That's test one. How about test two? What is the single reason you started saving money for in the first place when you were 20, 30, 40, 50? What's the answer for most people?
Because they wanted to supplement their Social Security in retirement with other income sources. So they saved money in their 401k or 403b, their retirement account. So there'd be enough money there so that they could take money off those assets to make sure they could do the things they wanted to do in retirement, and they wouldn't run out of money. That's why everybody saves their money, period.
And if you think about that, what's happened is you've strayed away from that because you've become such a good saver. And you've been a good saver, and then you think of yourself as now an investor, but you weren't an investor, you were a saver that was forced to invest because as you created this pile of assets, you had to put it somewhere to try to get a rate of return to make your money grow, but you started saving it for that purpose. And every one of the people that becomes our clients, they are really, really good savers. Otherwise, they don't become our clients because they don't have enough money needed to be managed for retirement income purposes. So our clients are really good savers. They save money, just specifically what you said, and that was for the sole purpose of creating a significant amount of income once they retire to create their lifestyle. If they now have decided they now are an investor because they have $3 million and it's diversified in all these different stock funds, etc., and then we do a risk analysis that shows that $3 million could lose 50%, at that point, they are an investor because they're taking too much risk. Because if we have that amount of assets and they have that much risk, they probably can't take more than about $90,000 of income off of $3 million. And at that point, after taxes, maybe $6,000, maybe $5,000 a month. That might not do anything for their lifestyle if they don't have any pensions, and they probably don't have pensions. 90% don't have big pensions.
Oh, this is the issue, Dan. When you said they could lose 50%, that goes in one ear and out the other. They don't really understand the risk they have in their portfolio. And until you have an analysis done on your portfolio, which we do every day, we use outside third-party research companies, we can tell you with great accuracy how much money you're going to lose if the market goes down by X percent. We can also tell you how much money you can make if the market goes up by X percent, right? So it goes both ways. But what it allows you to do now at this stage of your life to say, okay, you either accept the risk once you understand it and say, I will stay in it the way I'm in it right now, or you change it.
With income insecurity. So they talk about food insecurity. It's the same thing for people that don't have income. They have income insecurity, and it causes the most anxiety, causes the most worries, and will age you dramatically over retirement.
I can tell you right now, out of 100 people that have come in here over this last year, and we've done a risk analysis, A couple things. Number one, nobody ever understood the risks they had until we did the analysis. Number two, when we show them the analysis, 100 or 99.9 of them are shocked with the data. And number three, the great majority of them want it changed immediately because they never understood the level of risk they have, Dan.
Well, they do know intuitively if they suffer a big loss this close in retirement, they probably won't make it through retirement, or they won't be able to take any income out. So they decide they want to be more conservative. You're back with Dan Ahmed, Jim Files, the Peak Financial Freedom Hour. Thanks for hanging in with us and listening to the show. Today, we are talking about the subject, statements you may live to regret. We talked about a bunch of data. The first one was, we should defer income as long as possible and wait to start taking our minimum IRA distributions at 73. And we debunked that and showed that we need a more levelized income plan that will ultimately reduce your taxes on your IRA over time. Second one was, we don't need a budget. Well, that's a fallacy, because in retirement, the most important document isn't your asset statements or how much money you have. It's what is your monthly budget requirements, and then you build a plan to meet or exceed that. Then we just talked about, hey, honey, don't worry. We'll just hang in there and write out all stock market losses and we'll be okay. And that's exactly what you cannot do when you're in retirement. How about this one? I think this is the biggest one because it's what our firm's focused on. What if you say, I don't need a written plan? My advisor says I'm in great shape and I have nothing to worry about. I've had them as an advisor for 20 years and I trust them. For us at Peak, that's the worst thing anyone can ever think and anyone can ever tell you, that you don't need a written plan. That's like saying, trust me, another person, for the next 30 years of your life, and have no documents behind it. Never, ever, ever trust anything about your money unless it's in writing. For proof, dial pound 250 on your cell phone and say the keyword money, and we will send you a copy of our most recent book called The Golden Promise. That's pound 250, keyword money. The Golden Promise will teach you the mandatory nature of having everything about your money in writing. You cannot trust anyone. You should not trust your current advisor. You should not trust us. You should not trust anyone, even your spouse, unless everything is in writing, because that's the only time, Jim, you have proof if it's in writing, because now don't you have something that you can hold accountable and responsible and then check and review and monitor to make sure it's staying on track?
Yeah, but this is foreign to them. People are listening right now. You've heard us say this so many different times on these radio shows. We do a TV show. You might have been to our dinner seminars. You may have been in our office, but we are convicted to the fact that we don't believe you can have a successful retirement unless you have a plan in place.
Well,
not that it won't work out.
We will not even take a client on, and we will not
No.
design a plan. We will not invest any money of your money until you have that written plan you're talking about.
And it's not just, okay, this is your portfolio. This is how we're going to allocate your assets. That's the last part. A plan is to delineate precisely how much money are you willing to lose if the market goes down? How much income do you need every month, every quarter, every year for as long as you both live if you're married? How much income is going to come from each one of the investments? Is the income guaranteed? Is it not guaranteed? How does that flow for the next 30 years? What about my after-tax income? Will it be enough to maintain my budget? What about if I do need long-term care? What about inflation? Everybody's concerned about inflation. You should be, because if you have only 3% inflation in 20 years, your budget's going to be 60% greater than what it is today. You better have an income plan that lays all this out for you. If you had one, you'll feel more comfortable, Dan. The people will see the future and say, I get it. I'm going to make it. I'm going to be just fine.
Well, the reason people have never heard about a written comprehensive retirement income plan is there's very, very few firms out there who are providing that to you. We've looked in all of Sacramento, even in Southern California. We have not found one firm out there that will provide the type of written plan that we give to our clients. And there's no cost. There's no obligation to go through this planning process. We're going to give you your plan for free, and you never have to become our client. And it's going to show you exactly, Jim, what you talked about. Right now, if you're retired again, you're ready to retire, would you like to find out right now in writing how much risk you're really taking? Meaning, if the market goes down, how much you'd lose? And the answer is yes, we want to find that out. The second is, would you like to then determine how much risk you really want to take based on how much you're willing to lose? Most people say yes. Then the next step would be, how would you like to reallocate your assets and have in writing that if the market crashes like it did in 2000 and 2008, that you are projected not to lose any more than you want to lose? Maybe it's 5%. Everyone says, I want that. Okay, we can give you that. Everyone also wants to know where their income is going to come from for the next 30 years, meaning from each income source each year, how much their total income is going to be coming in, and they want to know how much tax they're going to pay. They want to know really the number one bottom line, number one that they want is that how much income am I going to have, Jim, each month to spend after taxes to make sure that I'm going to be able to keep for my budget. They want to feel comfortable that they're not getting gouged for fees, and they want to know that after they're gone, there's a high probability they can leave some money to the beneficiaries, and about how much can they leave. And if you can have all those answers, which you can, and again, it's free, dial pound 250 on your cell phone, say the keyword money. We will create a written comprehensive retirement income plan for you that'll answer all those questions.
There's a lot of people, Dan, that are procrastinators, right? You listen to what Dan just said. This is what we do every day, and this is what every single retired person needs, or soon to be retired person needs. You listen to it.
That's what they want.
This is what they want. But people become so complacent. They say, I'll get to this later on. I'll do this tomorrow. I'll do this in a week or two. But you need to do it now. You need to lay your plan out before you make a financial mistake. The stock market's at an all-time high. Markets go up and down. They ebb and flow. And what you don't want to do is procrastinate right now. Don't have a plan in place and realize in a year or 2 or 6 months that you could have done this and you didn't do it, and now you're in a different state of mind.
Well,
right?
People procrastinate because literally, if I was listening to our show and I didn't know a lot about money, I would think, okay, these guys sound great, but it sounds way too good to be true. It sounds way too good to be true because no one's told me about this. So we'll prove it to you. Again, everything in writing. Dial pound 250 on your cell phone, say the keyword money, and ask for a copy of our free book. Again, it's called The Golden Promise. It will put every single promise that we're going to make to you in writing, which means we have to adhere to those promises. We can't go against those promises. So dial pound 250 on your cell phone, say the keyword money, and get a copy of the book. Doesn't cost you anything. It'll take you about 2 hours to read, and it will change the way you view your money. And I believe if you read the whole book in 2 hours, it will literally change your life.
You don't have to do business with us. Read the book. It'll restate what we say every single week on this radio show. It'll restate everything we say on our television show that we run. It'll restate what we say in our workshops, our seminars. It's just a restatement. What if every single person wants is, how do I make sure I have enough income to get through the rest of my life? How do I make sure I don't make a financial mistake? And how do I position my assets right now today in this weird world to make sure those come true?
For more information about Peak Financial Freedom Group or to schedule a consultation, just go to our website, peakfin.com. That's peakfin.com. And thanks for watching.